Welcome to the deep dive. In a world that seems full of fleeting trends and just constant market chatter, have you ever wondered if there's maybe a deeper wisdom to investing?
Yeah, something that builds real lasting wealth, right? Not just chasing the next hot thing.
Exactly.
It's definitely a question a lot of investors grapple with, and it's pretty much what we're digging into today.
We are taking a deep dive into the Giverny Capital Annual Letter for 2024. And this, well, it isn't just some dry financial report.
No, not at all. It's more like a window, you
Yeah.
know, into a really thoughtful, long-term investment philosophy.
That's right. So our source today is Giverny Capital's comprehensive 2024 annual letter to its partners. They're a firm known for this really deeply rooted approach.
And our mission, for you listening, is basically to pull out the most important nuggets of knowledge and insight from this letter.
By the end of this, you should have a really clear understanding of Giverny Capital's core philosophy, see how they actually put it into practice.
And, maybe most importantly, grasp the sort of enduring lessons it offers any investor, really, no matter your experience level.
Think of it as your shortcut to being genuinely well-informed about a pretty distinct path to creating wealth.
And yeah, we promise to deliver some surprising facts, some practical takeaways,
Yeah.
hopefully help you gain knowledge quickly, but thoroughly, without
Yeah.
getting overloaded.
Okay, let's unpack this.
Sounds good.
So to really get Giverny Capital, you kind of have to start at the beginning with François Rochon back in 1993.
Right. He didn't just like wake up one day and decide to manage money.
No, he spent years really immersing himself in the writings, the wisdom of investing legends, Warren Buffett, Benjamin Graham.
Peter Lynch, Philip
Yeah.
Fisher, the list goes on. He synthesized their ideas into his own approach and started pretty humbly, actually, with just a family portfolio.
Yeah, and what's fascinating about that is the patience involved. It wasn't a quick jump.
No, it took 5 years. 5 years of getting, satisfactory results with that family portfolio before Giverny Capital Inc. was officially launched in 1998.
It really says something, doesn't it? Proving the philosophy before trying to scale it.
Absolutely. And then the way they built the team was also very deliberate.
Jean-Philippe Bouchard, JP, he joined in 2002. Became a partner actively involved in picking investments.
Then Nicolas Lequier and Corinne Primo in 2005, François Campeau later in 2018, and they expanded geographically too.
Right, to the U.S. Princeton in 2009, then partnering with David Popp in Manhattan in 2020.
And the letter makes it super clear. Every single one of these directors, they share that Giverny culture. And crucially, that long-term horizon.
Which brings us to how they view their clients. They call them partners.
Yeah, and that's not just, clever marketing speak. It's fundamental.
It's a core principle, right?
Exactly. They manage every client portfolio, exactly the way François Rochon manages his own money. Specifically, his Rochon Global portfolio, running since '93.
So it's truly being in the same boat, a complete alignment of interests.
Definitely. And you see that transparency commitment in the letter itself. Yes, it reviews the past year's results.
But the deeper goal is clearly to detail their long-term investment philosophy, meticulously.
They really believe the short-term market is often, well, irrational. But over the long haul, a company's stock price inevitably reflects its true intrinsic value.
So picking the right stocks, sound selection, that's everything for eventual returns. It's how they treat partners as they'd want to be treated.
And there's that nice little touch to the artwork on the cover.
Oh, yeah, the Giverny Capital collection. Marlon Kroll's echoes on this 2024 letter.
It just adds a bit of their unique identity, shows an appreciation for deeper value, even in finance.
Okay, let's get into performance, but always through Giverny's lens, that long-term vision.
Right. So 2024, the Rochon Global portfolio returned just under 25%, 24.9% to be exact.
Which was slightly behind its benchmark by about 2%. But, and this is the important part,
This is where the philosophy really comes into play. Because those short-term numbers, they often hide the real story.
so looking back further,
Since inception, July 1st, 1993, that Rochon Global portfolio has compounded at 15.1% per year,
15.1% annually.
compared to 9.8% for its benchmark. That's 5.3% annualized outperformance
Yeah.
over 30 years.
30 years. That's incredible consistency. And their goal is to keep doing that.
Yeah, their ambitious long-term goal is to consistently add about 5% annually above their benchmark.
And the letter shows this visually, right, with a graph.
It does, and it's powerful. It shows how $100,000 invested back in July '93
Okay.
would have grown to, wait for it, $8.4 million in the Rochon Global portfolio,
Wow, $8.4 million from 100K.
compared to only about $1.4 million for the benchmark. That's the difference patience and sound principles can make over time. It's just huge.
But they're quick to point out that graph is definitely not a smooth upward line.
No, absolutely not. And they highlight this. Over those 3 decades, the market dropped 50% twice.
50%.
Twice. And over 20% drops. 7 times.
So the key takeaway from that kind of, well, gut-wrenching volatility.
It's the absolute necessity of having that long-term horizon, perseverance, sticking rigidly to your investment principles, and just patience, weathering the storms.
Like they say, fashions come and go, but good principles endure.
Exactly. That sums it up perfectly.
And they also break down the numbers for their regional portfolios.
They do. The Rochon U.S. portfolio started in 2003, U.S. dollar terms. It returned 17% in 2024.
Okay, how did that compare?
It underperformed the S&P 500 that year, which did 25%. So about an 8% lag for the year.
But again, the long view.
Since 1993, it's returned 14.1% annualized versus the S&P 500's 10.6%. So that's still 3.5% added value annually over the long haul. Solid.
And the Canadian portfolio.
The Rochon Canada portfolio started in 2007, focused on Canadian stocks. In 2024, it actually beat its benchmark, the S&P TSX, by 1%, 22.7% versus 21.7%.
Okay, slight outperformance there.
But look over the 18 years since it started. It delivered an amazing 17.0% annualized return.
17% annualized.
Yeah, versus its benchmark 6.8%. That's over 10% added value annually.
Wow.
It really highlights their point that a carefully chosen, highly concentrated portfolio can significantly beat the index.
Right. Let's shift focus a bit to the broader market picture in 2024. It was a strong year generally for stocks outside the U.S. too, but the S&P 500 really stood out at 25%. What was behind that?
Yeah, and this is where the letter offers a really critical perspective. That huge S&P 500 return. It was massively driven by the Magnificent Seven stocks.
Okay, the big tech names.
Right. Those 7 returned a staggering 48%. And now they make up over a third of the entire index weight.
A third. Just 7 stocks.
Yep. And they contributed half of the index's total gain in 2024. If you look at the equal weight S&P 500, where every company counts the same, it only returned 13.0%. Big difference. Giverny calls the S&P's current concentration unmatched in history.
And that kind of concentration raises flags about valuation, doesn't it?
Huge flags. The letter points out the top 4, Apple, Microsoft, NVIDIA, Amazon, they traded an average of 33 times expected 2025 earnings.
33 times compared to
just 19 times for the other 496 companies in the index.
It's a significant premium.
It is. And they give this really sobering example. Even if those top 4 managed to double their earnings per share by 2030, which is like 15% annual growth, pretty strong.
Okay.
If their PE ratio just fell back to a more normal 20 times earnings, investors might only see about 4% annual returns from these stocks.
Ouch. That really shows the risk of overpaying, even for what seem like amazing companies.
Exactly. It's a classic risk. Now, zooming out a bit, how does Giverny view politics in relation to investing?
They have a very clear, very firm stance on this. They state they always refrain from making comments that are political in nature.
So they just stay out of it.
Completely. They believe it's a big mistake for investors to get distracted by political events. Their job, as they see it, is picking companies for the very long term.
Right. They often hold stocks for over 10 years.
Which is much longer than most political terms. They actually say they're confident their businesses won't be substantially affected by, say, new U.S. administration trade policies or tariffs.
Interesting. So what about their outlook for 2025, given all the global uncertainty?
They describe their view as agnostic on the overall economy and stock market. They acknowledge the concerns, trade tensions, conflicts, tech disruptions, climate change.
Yeah, plenty to worry about.
They even quote Sidney J. Harris. When I hear someone sigh that life is difficult, I am tempted to ask, compared to what?
Huh. That's a good line. Perspective.
Right. But despite all that uncertainty, they express confidence that their owned companies will achieve record profits in 2025.
That's a remarkable focus, isn't it? Focusing on the businesses they own, the micro, despite all the macro noise.
It really is. Now, the letter also has a section on Canada's economy. They note it's mainly for their Canadian partners, but there are broader lessons.
Okay, what's the main point there?
They identify a major problem: very low productivity growth in Canada.
Low productivity. How does that compare?
Well, U.S. GDP per capita has grown at least 14% more than Canada's since 2015. And Canada is apparently dead last among G7 countries on this measure.
Dead last. Wow. So it's not just about the total size of the economy.
No, it's about individual prosperity. They point out that while immigration boosted Canada's total GDP, GDP per person hasn't kept pace. Meanwhile, social program costs per person have gone up.
And do they suggest reasons why?
Key causes they point to are Canada having the highest total tax on distributed profits among G7 nations and significantly low private sector investment. It's about $10,000 less invested per job each year in Canada compared to the U.S.
$10,000 less per job per year. That adds up.
Massively. They quantify the impact as a relative loss of about U.S. $7,400 or CAD $10,000 annually per person.
Really?
Multiply that across the
If
population.
you get a huge number.
Over $400 billion less GDP per year for Canada. And they link this productivity lag partly to the Canadian dollar falling 9% against the U.S. dollar in 2024.
Makes sense. What's their proposed solution?
Pretty straightforward. Encourage more entrepreneurship and more private investment. It's a reminder, really, for any country about how certain policies can impact long-term growth and prosperity.
Yeah, definitely a universal lesson there. Okay, let's shift gears and dig into Giverny's actual investor toolkit, starting with this idea of owner's earnings.
Right. This is core to their philosophy. They really believe in acting like actual owners of the companies they invest in, not just, trading stock certificates.
So they use Warren Buffett's concept of owner's earnings to estimate intrinsic value. They've been doing that since 1996.
Can you unpack owners' earnings a bit more? How's it different from just, say, reported earnings?
Sure. Think of it like this. It's not just the profit a company shows on paper. It's trying to figure out the actual cash flow that a real owner could pull out of the business or reinvest after accounting for all the money needed just to maintain the current operations and competitiveness, the capital expenditures.
So it's a more realistic measure of true profitability.
Exactly. It adds a layer of realism. Their attitude is pragmatic. It is better to be roughly right than precisely wrong. They know it's an estimate, but it's a better estimate.
And the long-term data seems to support this approach for them.
Oh, absolutely. Since 1996, the companies they've owned grew their intrinsic value using this owner's earnings concept by about 266%.
Okay, 300 and 266% growth in intrinsic value and the stock prices.
Their stock prices achieved a total return of 344% over that same period.
Wow, that's incredibly close.
It is. Annualized, it's like 12.9% intrinsic value growth versus 13.0% market performance.
Okay.
They call it an undeniable similarity. For them, it's proof that long-term stock prices really do follow the underlying value of the business.
But Giverny doesn't just talk about their wins. They do something pretty unusual.
Yeah, this podium of errors section is fascinating. They transparently share their biggest mistakes, not just purchases that went wrong, but
the ones they didn't make, the opportunities they missed.
exactly. And they argue that these errors of omission, the non-purchases, are often way more costly than the errors of commission, the bad buys.
That's a really profound point for any investor who's ever hesitated and missed out. So let's hear about their top 3 misses.
Okay, bronze medal goes to Apollo Hospitals in India. They looked at this company back in 2007. Leading hospital firm, digital, low cost, seemed promising.
So why didn't they buy?
Reasons were things like geography, culture, concerns about the Indian rupee maybe weakening, understandable hesitation.
But the opportunity cost.
Huge.
Yeah.
Revenues grew 20 times. The stock went from 250 rupees to over 6,200. That's a potential 1,400% return, even after the rupee fell against the Canadian dollar. Ouch.
Okay, silver medal.
Ameriprise Financial. This is a spin-off from American Express back in 2005. Giverny actually owned shares initially, but sold them.
Why so?
They cited a lack of enthusiasm and felt it didn't have a strong enough competitive advantage. Big mistake.
Big.
Well, earnings per share went from $2.80 in 2005 to $35 in 2024. That's 14% annual growth. The stock is now $563. Over 1,500% return missed over 19 years.
1,500%. And didn't they say they missed it again?
Yes, that's the kicker. They passed on it again in 2019 when it was trading at just 9 times earnings. Then it quadrupled in the next 5 years. Double ouch.
All right, so the gold medal for the worst mistake.
This one goes to Cintas uniform rental business. Giverny described it as a perfect fit. Not sexy, but hyper-stable, recurring revenue, very profitable.
And they understood the industry well.
Extremely well. They had met with the CEO of a competitor before. Then in 2016, Cintas bought a competitor, G&K Services. Giverny saw the potential synergies.
Right.
But the valuation seemed high at the time. The stock was $26 top, trading at 26 times profits. So they waited, hoping for a better price.
Which never came.
Nope. Expected earnings for FY 2025 are $4.35 per share. That's up 326% in just 9 years, over 17% annual growth. Revenues doubled. The stock today, $204.
$204 from 26.
Yep. A 700% gain since 2016, or 25% annualized? They missed it. Giverny calls it the worst mistake, because in Rochon's words, it was a pitch right in the middle of my strike zone.
Wow, those stories really hit home. Sometimes the biggest risk, truly, is inaction.
It really makes you think, okay, now let's try to deconstruct risk itself. It's a word thrown around a lot, but Giverny has a specific way of looking at it.
Right, and they start by citing Buffett, who challenged the idea that high returns must mean high risk.
Exactly. Buffett showed you can get high returns with low risk if you know what you're doing. Giverny emphasizes that judgment and experience matter way more here than just running numbers through an algorithm.
So how do they break down risk in a portfolio? They have 4 levels.
Yeah, 4 levels. First one is portfolio diversification.
Okay. How many stocks is enough or too few?
Well, they suggest around 20 securities offers a good balance. It's enough to increase your odds of outperforming, but it reduces the risk of having all your eggs in one basket, concentration risk.
But they contrast that with some legends who hold only like 5 or 6 stocks.
They do, but they note those investors pick stocks that were very low risk on other parameters. The real danger, they warn, isn't just having 5 or 6 stocks, but having them all in the same sector, like all tech, for instance. That's not truly diversified.
Okay, diversification is level 1. What's next?
Level 2, and they say this is the most important parameter, the quality of businesses.
The actual companies you own.
Exactly. What makes a high-quality company? Strong returns on equity, low debt or at least conservative finances, conservative accounting, high debt or aggressive accounting. That increases risk.
And what about the business model itself?
They look for sustainable competitive advantages, durable models that aren't likely to be completely disrupted overnight. Why? Because faster industry change inherently means more risk.
Makes sense. Stability matters. Level 3.
Stock market valuations. Price matters.
Even for great companies.
Especially for great companies. Yes, quality deserves a premium, but the higher that premium, the greater the risk you're taking on. It's pretty simple. A stock at 40 times earnings is just riskier than the same stock at 20 times earnings.
This sounds like Ben Graham's margin of safety.
Absolutely. It's a key ingredient for reducing risk buying something for significantly less than you think it's worth.
Okay, diversification, quality, valuation. What's the 4th level of risk?
This one is crucial. The investor's own behavior.
Ourselves. We're a risk factor.
Potentially the biggest one. They stress that even the most brilliant strategy is useless if you panic or try to constantly time the market.
How does holding period relate to risk here?
Directly. The longer you hold an investment, the more its performance is likely to track the actual performance of the underlying business, its intrinsic value growth. Short term, it's much more random.
And they contrast holding periods now versus historically.
Drastically. Back in the 1950s, the average holding period for a stock was about 8 years. Today, it's closer to 8 months.
8 months, that's barely investing.
Tell me about it. And Giverny's own average holding period, still 8 years, they walk the talk.
And they give that extreme example of the SPY ETF.
Yeah, the S&P 500 ETF, SPY, average holding period in 2023 was just 17 days.
17 days. That's insane.
It led John Bogle, the founder of Vanguard and index funds, to quip that ETFs are like giving matches to arsonists.
Wow. What did he mean by that?
He meant people were taking a tool designed for long-term, patient investing in the index fund and using it for hyperactive, speculative short-term trading, turning something potentially beneficial into something reckless.
It really drives home their point. Often, our worst enemy in investing is ourselves, our impatience, our emotions.
Wouldn't agree more.
All right, let's wrap this up by quickly revisiting Giverny's core investment philosophy. They lay it out clearly in an appendix, especially for new partners. These principles don't change for them.
Right. First, the bedrock. Stocks are the best long-run investments, period.
Second, trying to time the market. Futile. Don't bother.
Third, and this ties back to owners' earnings, stock returns eventually echo the underlying company's intrinsic value growth. It might take time, but it happens.
And they emphasize which companies to choose. High sustainable margins, high returns on equity, good long-term prospects.
And critically, management that is brilliant, honest, dedicated, and even altruistic. That last one's interesting.
It is. And conversely, they avoid the risky stuff. Non-profitable companies, too much debt, highly cyclical businesses, Management driven by ego?
All the red flags.
Mhm.
Plus, they stress needing a realistic assessment of intrinsic value. You can't just make up numbers.
And they actively use the market's craziness, right?
Yeah, they leverage the market's irrationality when it treats stocks like casino chips to buy great businesses when they're cheap, below intrinsic value.
And the final principle here.
Patience. Patience is key. The market might ignore a great company for a while, but if the business fundamentals are sound, the stock price will eventually catch up.
And this leads to that counterintuitive view of volatility. Most people hate it.
Right, most people see volatility as risk. Giverny sees it as an ally.
An ally. How so?
Because those market swings, those moments of panic or euphoria, create opportunities. They let the intelligent investor buy superb businesses at attractive prices when others are fearful.
They echo Benjamin Graham again here, don't they?
Yeah, Graham saw market irrationality as an extraordinary advantage. Unless you let yourself get swept up in the short-term noise, then it becomes a disadvantage. It's all about keeping your head when others are losing theirs.
So pulling it all together, what are the big takeaways from this deep dive into Giverny's letter?
I think it really boils down to the power of a truly long-term, patient, quality-first investment philosophy. It sounds simple, but it's hard to execute.
And the importance of learning from mistakes, especially those errors of omission, the things we didn't do.
Definitely. And getting a much more nuanced understanding of what real investment risk is. It's not just about stock price wiggles. It's about business quality, valuation, diversification, and crucially, our own behavior.
It really reaffirms Giverny's commitment. Selecting outstanding companies, being good stewards of capital, focusing on strong balance sheets, dominant businesses, reasonable prices.
Always balancing that search for return with very sound risk management. It's a consistent message.
So maybe a final thought for everyone listening. In a world filled with market noise and super fast trading, how much of your actual success might hinge less on exactly what you buy and more on how long and how patiently you choose to hold it?
Yeah, or put another way, if the biggest risk in your investment journey really is yourself, your own reactions, what's one deliberate step you could take, maybe even this week, to align your behavior just a little bit closer to a proven long-term philosophy like Giverny's?
Something to definitely think about. Thanks for joining us on the deep dive.